All right, so today we want to look at how to study all accounting standards. So how to study all accounting standards, as financial reporting or corporate reporting standards. So how to study all accounting standards, that's what we are going to look at today. Now, anytime you take any international accounting standard or any international financial reporting standard, you have to pass it through some specific process or some specific, procedures. And these processes or these procedures guides you in understanding the particular standard and solving all questions, either theory or practical questions under that particular standard. So that is basically what we are going to look at, how to study all accounting standards. All right. So the first thing you are supposed to do or look out for when you take any accounting standard is to look out for what that particular standard cover. So in my words, I term it what it cover. Now, with what it cover, we are looking at about 2 or 3 things. So here we are looking at the definition of key keywords or key terms in the standard. So anytime we take a particular accounting standard, we are looking at the definition of keywords in that particular standard. Then we are looking at the scope. We are looking at what does that particular accounting standard cover. For instance, if you take IAS2 inventories, it covers only assets that are finished or that is held for sale. It also covers only assets that are held in the production process, that is work in progress. We also have assets that are in a form of raw materials used in the production process. Any particular item that falls outside the jurisdiction of the 3 categories of inventories I've mentioned is not captured under IAS2. So we want to look at the scope. If you take a particular accounting standard, the scope that it covers, what does it cover? If you take financial instrument, that is IAS2 and IFRS 9 and IFRS 7, if you take those particular standards, we are only looking at what financial instrument. Anything like investment property has been captured under IAS 41, so it does not come under what IAS 32 or IFRS 7 or IFRS 9. So what does the particular standard cover? That has to do with what? The scope. So after you defining your key terms and then your keywords in that particular standard, and then knowing what the standard cover, then you have to look at the objective of that particular standard. So objective. So most of the objective of the standard is to prescribe the accounting treatment of that particular item the standard was devised for. So if you take IAS 12, that is income tax or taxation, is to prescribe accounting treatment for what? For income tax. If you take IAS 16, is to prescribe the accounting treatment for what? Property, plant, and equipment. If you take IAS 23, is to prescribe the accounting treatment for what? For borrowing cost. That is the objective of that particular standard you've taken. Always you have to bear that in mind. After knowing what it covers, then the next step or the next procedure is to look out for when we should recognize it in the books of the entity. So now you've looked at the definition, you've looked at the scope, you've looked at the objective. Then the next thing is, when should we recognize it? So here we call it recognition. The recognition is basically when should we capture that particular item in the books of the entity? When should we include that particular item in the books of the entity? Should that particular item meet certain criteria or some specific criterion? Should it be met before we include it in the books of the entity? Here we are supposed to look at that. And it's very, very important. In fact, almost all the accounting standards, you have to know when you should recognize property, plant, and equipment, when you should recognize inventories, when you should recognize financial instruments. This is very, very important. So you have to, anytime you take a particular standard, you have to look out for the recognition criteria for including that particular or recognize that particular item to be what? To be an inventory, or it's not supposed to be what? To be inventory. The general criteria for recognizing an item is established in the conceptual framework, that is when that particular item meets the definition of asset and liability, and also meets the qualitative characteristics information of that is relevant and what faithful representation. But sometimes some specific standard have their own criteria for recognizing a particular item in the books of the entity. So once you have that have been outlined in that particular standard, whatever that has been done there overrides or prevails against that of what has been enshrined or outlined in the conceptual framework. So remember that after you knowing what it covers, like the definition, the scope, and then objective, you have to look at when the criteria that you are supposed to meet before you include that particular item in the books of the entity. Now, the next step or the next procedure after you recognizing that particular item is measurement. Now, you have recognized that at the end of this month, I have to recognize inventory in my books. But how much? You have to measure it. So that is measurement. So that is the third one. So we have measurement. And measurement here we have two things. We have initial measurement, and then we have subsequent So we have initial measurement and we also have subsequent measurement. Now, with the measurement, we are saying that you know when you are supposed to include a particular item in the books of the entity, but what amount you should include, you don't know. So the first one, the date or the day that you are recognizing the item in the books of the entity, what amount should you attach to that particular item? That will be your initial measurement. Most of the standard have their own way of initially measuring, that particular item. Like if you take IAS 32 or IFRS 9, that is financial instrument, they are mostly initially measured at their fair valued. If you take that of inventory, IAS2 inventory is measured at the lower of cost and net realizable value. So most of the items have their own ways or their own initial measurement criteria or initial measurement guidelines. So if you recognize a particular item, the amount that you are going to attribute to that item on the first time that you are entering it in the books of the entity has to do with what? Your initial measurement. Then if the item is going to stay in your books for more than one accounting period, then if an accounting period ends, what amount are you going to attribute to that particular item? That has to do with what? Subsequent measurement. If the item is going to stay in your books for like 10 years, for more than one accounting period, then if one accounting period ends, I have to look for a value for it. It will not be still measured at what? Initial measurement. So that, approach is what we call the subsequent measurement. So having understand initial, that is measurement, that is we have initial measurement and subsequent measurement, then the next step is derecognition. So after you've measured, subsequently measured, then the next step is derecognition. This one is when out. So when we have when in, here we have when out. This is when should we remove either partial or full removal of the item from the books of the entity. When should we do that? That has to do with what? The derecognition. These two, sometimes when the economic benefits attributed to that particular item is fully enjoyed by the entity, then it's supposed to be disposed of. Or when the useful life of that particular item is exhausted or expired. Or when there is, when the entity loses control over that particular item, or when there is no obligation to be fulfilled by the entity, then that particular item is supposed to be removed from the books of from the entity. That has to do with the derecognition. When should we remove or take it off? When recognition is when should we bring it in, derecognition has to do with when should we remove it from the books of the entity. Now, after understanding the recognition, the next thing you're supposed to do is to explain the activities that you have done in the standard. When are you supposed to do your initial measurements? What are the criteria? All those things are coined under presentation and disclosure. So first you present. Most of the times, students know how to do the calculations, but when it comes to presentation, they always get it wrong. Presentation is whether you are going to debit that particular item or you are going to credit it in the books of the entity. Which account is it going? Is it going to the OCI? Is it going to the P&L? Is it going to the statement of changes in equity? Is it going to the cash flow statement? Is it going to the statement of financial position? That has to do with what the presentation. And then the disclosure has to do with the information about all the key things that has been done in that particular standard. Should be what? Should be disclosed. You should tell the users that you went to borrow this amount, you went to, buy this new asset, or this particular asset is an inventory because of this criteria, and so and so. You give information about everything that has been done in that particular standard, and this is coined under what? Disclosure. So basically, when you take any accounting standard, you pass it through all these steps, and you'll be what? You'll be good to go. You will to establish understanding and will help you in solving all practical and theoretical exams with an ace. Remember that it's not every accounting standard that will take the steps chronologically. Some may jump this one, some may jump the rest, some may even change it. But in all, you will have these steps falling in when you want to study any accounting standard. Thank you.